everyone. Welcome to Mortgage Pros 411. I'm Audrey Boissonou. I'm here with my co-host Kevin Cassey and Dr. Elliot Eisenberg. So I had the pleasure of listening to a presentation that you did, Elliot, or Dr. Eisenberg, and realized how amiss I have been with your intros, where I didn't use words like internationally acclaimed. That is how he was described. So with that being said, we have the internationally acclaimed Dr. Elliot Eisenberg with us today. He is going to enlighten us about what's going on with the economy and how that impacts mortgages. Yes. All right. But before we do that, I just want to say that tomorrow, because there's never a lack of things going on in our industry, pending home sales will come out. Thursday, we get the final read of Q4 GDP. That'll be titillating. And then on Friday, PCE, which is personal consumption expenditure. So that is an inflation measure. So let's just start with inflation, because why not? We have a Fed who is hell-bent on taking care of inflation after being apparently on an island somewhere for about 8 months when they should have been attending to the economy. But no, everything was fine. They took some time off. And then when they finally figured out that it wasn't okay, we have had nonstop rate hikes. It's crazy out of control, and a 2% target that I'd like to talk about a little bit. So PCE on Friday, let's talk about that. What is that going to look like, if you have any clues on that? And what is that going to do? I mean, I know it's anyone's guess, but yes, you're an economist.
Anyone's guess. The trend is it's going to start to come down at some point. I think one of the major reasons it should start to come down is housing. We know that rents month over month are coming down, and we know that it's not as big a proportion of PCE as it is CPI for a bunch of other technical reasons, but it's a big deal. And we should start to see those month over month rent declines slowly coming into the CPI and PCE. Now, there's other things going on as well, so it's not unmitigated guaranteed decline, but the economy should be slowing. Inflation has been weakening from 9 to 6% or 6.4, or whatever it is. So it should be coming, it should continue to fall. The bigger issue is how much it falls. That's really the issue. Does it fall 1/10, 3/10? That's more important than whether it falls. Right. And the year-over-year number matters much more than the month-over-month number. I'm not sure that's fair, but that's how it goes.
Right. So if what we have been told is to be believed, we are looking at May before there is some real significant improvement in inflation. And so we just ride this wave, right, until we get there and expect volatility.
Yes, the bigger thing is what the Fed cares about. And the Fed has said, look, they care about something they call super core services, I think they call it. I'm not sure, but it's core inflation minus it's all services minus energy minus housing. So even if housing does drive it down, that would improve the atmospherics, and the Fed could say, look, things are coming down. We don't breathe on us so hard. But that super core services number is what they care, and that's mostly being driven by wages. So if the market may dance prematurely, if this is a good number, the Fed may still be saying, we're going to keep rates where they are. We're not going to lower them because we haven't seen wages decline, and that's what they're most focused on.
I'm always amazed at the inflation numbers that exclude food and energy, since, when eggs are $68 a dozen, and gas is through the roof. And here in California, we're looking at another government hike as far as taxes go in July. I mean, I'm paying $5.39 a gallon right now for gas, even though they're saying that gas prices have come down, oil has come down. And so I don't understand the disconnect between these things that we actually pay. It impacts our lives, not just my life, everyone's lives, presumably. And they're just like, whatever, we're looking at price stability and jobs. Like, that's it. That's all I care.
Let me give you an example to try and reframe.
Thank you.
Think of this example. Let's suppose the eggs are not a bad example, actually, or egg prices go bonkers. Eggs are a very small amount of money we spend on eggs. It's just not a lot of money. We spend, $3 a week on eggs, or $2 or $4 a week on eggs, $200 a year.
Audrey spends $50, but that's okay.
Ah,
We just eat nothing but eggs. That's all we
Every-
eat. So
every
yeah,
breakfast.
huge impact on our budget. But go ahead.
Yeah.
So let's suppose it was a bigger sector like oil, where it really can have vast economic impact. And let's suppose the reason the price of oil goes up is because of an Iranian attack on Iraq, which happened on Saudi Arabia, which happened a couple of years ago. They advocate with the missiles, and you lose 3 or 4 million barrels of oil a day because of some weird one-off thing. That's enough to drive the economy into recession here in the US. If it lasts long enough, a couple bucks more a gallon, that could really do damage. Should the Fed really raise rates because of that? That's nuts. That's taking a bad situation and making it much worse, because we know that inflation will go away. Food and energy inflation, bounce around a lot. Energy inflation goes back to where it was because raw oil prices, there really does return. Like it was $20, it goes to 70, 120, and then it's back to 70 now where it was before COVID began. So we know there's true back to normal numbers on those, and they go up and down because of weather and war.
Right.
And those things shouldn't influence monetary policy because they're not anything the Fed can control. They're exterior to the US and they're just weather and war. So the Fed says, look, we're going to look through it and ignore it. We could argue that's not a good decision. I think it is a good decision, but that's exactly the thinking. And it's taken economics literally 40 or 50 years to really grasp this. They began in the 70s to really grapple with how do we measure inflation? We had terrible inflation back in the 70s. What was the right measure? Is it median inflation? Is it sticky inflation? Is it disinflation? Is it truncated inflation? There's all kinds of measures. But the general agreement was food and energy out because they just messy the waters and deprive us from seeing the underlying non-food and energy trend, which was what we care about. And the Fed's now gone beyond that with the housing and energy and the services and whatever because of COVID. Again, we want to say COVID drove energy up for a whole bunch of weird reasons. Well, now COVID's going to go away, so it's going to go away. It went up and come down for the same reasons. Let's ignore that and focus on what really is going to have staying power.
All right. Well, we'll ignore my $1,600 a month PG&E bill for the moment, just so that we can move this along.
But look, they're going to chop down trees and make those wires resistant to the sparking and things are going to be better.
Don't even get me started. Okay, can you briefly, as only you can do, explain the difference between fiscal policy and monetary policy so that our brains don't explode, please?
Sure.
Mostly mine.
Fiscal policy is determined by Congress, and it means taxes and spending.
Got it.
Monetary policy is interest rates done by the Fed. And the Congress, in theory, Congress is the Fed's boss.
Right.
But Congress has outsourced monetary policy to the Fed.
It's probably best. They certainly, well, okay. I should probably try and behave myself. In our visits to them, they don't understand monetary policy like we would hope they might, since they are, driving a lot of all of the legislation. So, okay. So,
just to echo that, they could actually bring down inflation by fiscal policy.
Sure, Congress could do Congress could do things to help.
If Congress and the Fed got together, they could really reduce inflation. But sometimes it feels like they kind of go counter to each other.
Yeah, the counter is not a good idea. But I think Powell was asked that question last week in his testimony. For example, someone said, "Isn't fiscal policy working at cross ends of monetary policy?" And he answered it delicately and said, "A, we don't tell fiscal policy makers what to do. That's their job. We do our job." A, and B, he said, "Look, it was bad before, but now it's good." But behind the scenes, I'm sure they talk a bit, but there is really an attempt to keep the two relatively far apart. The central bank says, well, look, Congress does what it does, and we're going to try and get inflation down. Whatever they do, we're going to get inflation down. That's because it's bad. You don't want Congress interfering in monetary policy. You don't want the Fed interfering in fiscal policy.
all right.
It's a good system. It's wonky, but it works.
It's pretty good. The alternative is worse, like democracy, a terrible form of government, but everything else is worse.
All right. Well, moving right along.
Yeah. Okay.
we weren't really going to talk about the attributes of communism today, so that's not on my list of things. Okay, so the Fed hiked another quarter, and we are expecting what going forward? Another quarter? I'm hearing maybe two, but maybe that's it. But no easing anytime soon. Does that sound about right?
That I think perfectly encapsulates what Powell said. Of course, Powell knows nothing. Not that he's stupid, but he doesn't know the future. If he knew the future, we wouldn't have business cycles. We wouldn't have recessions because they'd know when and how much to raise rates and when and how fast to lower them. And we'd have a perfect economy that's flat all the time. So this is their best guess. But don't forget, this bank turbulence with SVB and so on, and a couple others, First Republic and Signature and Silvergate, has caused some upset and upset the apple carts here. And no one knows if this has lasting damage or not and how long it will be. Is it serious and how long will it be serious for? It seems like it's already coming down pretty quick. So I think the lasting damage will be harder to get loans. That's no doubt.
Yes, that's what we're seeing. And it's something actually that's a telltale sign, because we have a good friend who gave me a hint back in December that Silicon Valley Bank had cut back on commercial loans and started pulling lines. And he goes, that's the first sign that they're in trouble. This was back in December.
Wow.
And yet in February, there's, some investment guy saying, oh, buy Silicon Valley Bank. They're a cheap deal. That's when their stocks are at $300.
Well, and they've gone through an audit.
Worst call in the world.
An audit 2 weeks previous to this that said, oh, you're good. Don't worry.
Yeah, Signature also had the same audit by one of those major, big 4 or 5 accounting firms. I forgot which one.
Oh, yeah, they're all good.
Why do we still listen to them? I don't understand. Like, we had the rating agencies, before the meltdown. We have everyone saying everything's fine. It's a bunch of hooey, and that we still follow that. I don't get it.
But it's whenever something goes wrong, everybody goes, well, not me. They all say, well, I didn't do it. I wasn't involved. It was the general contractor's fault. It's the sub's fault. Apple says it's Microsoft. Microsoft says it's AWS. Everyone's blaming somebody else.
There was a great article in the Wall Street Journal this week, and it compared Silicon Valley Bank to other banks and how their investments were and such. And it was like, well, wait a minute. Their investments are almost identical to everybody else's investments. Yeah, they're a little more commercial, then a little less consumer debt, but overall, like minutia details. And it's like, okay, this tells me 2 things. One was, okay, well, they did everything else everyone else has done. Wait a minute, what's going to happen to everybody else, because they were the first shoe to drop. So
their problem at the end really was the run on the bank was so intense and so fast.
Oh,
Had
yeah.
it taken a couple of days or a week to do that run, you might have been able to sell the bank or boost it up or something. But $40 billion in that morning, that Monday or Friday morning or whatever it was, all through your phone. It's like
I mean, the number of people I know in the industry that have bank relationship with them, because we're here in the middle of Silicon Valley ourselves.
Yeah.
I mean, I know a firm that had over $1 billion.
Whoa.
Uh-huh.
I had actually a couple of friends of mine have it in private bank, which is in Boston. And they bought that bank a couple of years ago or something.
Yeah.
In Wellesley or somewhere in Massachusetts, near Boston. I have some friends with money in there, and they had a bad weekend, and their wives were not happy.
Yeah, no, well, a really interesting thing, because this particular firm, they've actually now, since all this has happened, have added 300 million to that deposit, because they say it's 100% insured.
Guaranteed.
We're good. Now, the one that they're running the little risks is like some banks won't wire to them. They're like, well, we don't want it. We don't feel comfortable. Like, okay, well, you wire to our Chase account and we'll just put it over there. That's fine. Because we don't want a $300,000 sitting in Chase. We won't mind it sitting in Silicon Valley because they're 100% insured now. At least they are until they get bought out. But.
Do you know 50% of the deposits that transferred out of Silicon Valley Bank with the Chase? 50%.
Yeah.
That's a crazy number.
Over the last several weeks, we've seen deposits at the big 4 or 5 banks go up, and all the other banks and the regionals go down.
BofA only got 3% of them, which I thought that was interesting too. So Chase got 50%, BofA got 3%, and then there's all these little.
What I'm hearing from people though is it's really difficult to move the money from the small banks to the big banks. The big banks can't seem to handle the volume of the accounts being opened up and shifted over.
Transactions or something.
Yes, they can't handle the volume of transactions. And that's actually one of the things that both Silicon Valley and First Republic, that's their area of specialty, and that's why all these venture capital firms deal with them, is they can handle the volume of wire transfer requests that the big banks are too bureaucratic.
And the service was great. Everyone says the service was spectacular.
Yeah.
I would like a good bank to
the
give me
problem-
good service too. I would like that.
Actually, it would really affect, if Silicon Valley Bank and First Republic were to go down, it would really handicap the venture capital world.
Right.
And just would slow their ability to give money to fund.
And that's going to hurt the whole Silicon Valley area, the whole San Jose, San Francisco, north to south area. But all these, but in general, it's going to get hard to get loans for everything. Car loans, personal loans, signature loans. Everyone's going to go. That's going to act like a rate hike. So the Fed says, well, look, if that's worth a hike, we don't have to do the extra hike because the bank thing just did a hike for us. And they want to see how much power that banking thing had in terms of rate hike equivalence, if you will.
Yeah, no,
it's happening right now. I mean, we are hearing from reps who are just getting a deluge of these loans that were approved somewhere else, no longer approved. And these people are in contract, they're scrambling. So everyone needs to be on their A game. This is our opportunity, really. Be aggressive. Banks are tightening. The loans they were doing are no longer possible. They're not doing as many favors for the private banking people just because they're worried, they're scared, and they're going to have to explain their actions should there be a problem. So if we're proactive, this is an opportunity. And I thought it was interesting because the retail channel for jumbo loans in 2022 closed 77.2% of jumbo loans. It was down slightly from the year before. That was 78.7%. Correspondent went from 14.8 to 18.1%. And then brokers were 4.6% of jumbo loans that were closed. But the point is, we have an opportunity right now because, Wells Fargo correspondent went under, make sure you know what options are available to you. And if you don't have all the options that are available to everyone else, maybe you make some adjustments in where you are, what you're doing, because that's going to be very important going forward. You've got to be able to close loans. So, and make sure that you're touching base with your referral sources, because for the places where they can't close a loan, let's say they have someone walk into the door of their retail bank and they can't close it, make sure they know who you are, so they're sending it to you, right?
And if the other thing is, find other alternatives. What else? I spoke to a group of private capital people, and they were all licking their chops. This is their chance. They're going to charge more money, but you can come to our door and we'll give you loans. So all kinds of credit unions. I mean, there's other things out there for other purposes.
Right.
But
100%. And the other thing too, I think is interesting is, again, we've been saying this for a while. As lenders, as brokers, we need to be firm with our borrowers. I literally saw a conversation the other day where someone was saying, oh, well, I'm looking for X because my borrower doesn't want what is available. Well, you know what? Your borrower just had a bankruptcy and God knows what else is going on with him. It was this crazy scenario. Oh, but he doesn't want this, or they just came out of forbearance, or, right? You need to tell your borrower firmly, here's the deal. This is what's available. It is not then, it is now. And be strong. Don't let them bully you, because I believe that we have done a lot of that always. We've always been bent over backwards for these borrowers who are demanding these things that may or may not exist. So make sure you know what exists or doesn't, and then be strong. Be strong. Don't let them bully you.
9.5. Take it or leave it.
What? What'd you say?
I said I just tell them 9.5. Take it or leave it.
Ha ha ha. But you can also tell them.
Quoted 18.99% yesterday. Her boss got mad at her, but she's like, "Hey, I just want to make sure I've quoted it high enough so that if I need that rate to sell it to Wall Street and anything else that comes in better than that, the borrower will be thrilled." So, again, rate is only an issue if you let it be. So yes, you're going to have certain borrowers who aren't going to like what you say, but if you're saying what reality is, then they're going to have to get with the program or they don't get a loan.
But look, you can also tell them, look, home prices in Silicon Valley or wherever it is in Alameda County or, whatever it is, San Mateo, they're down 7 or 8% from what they were a year ago. So the world's a different place on the buy side too. Look, your house price is not what it was. Rates aren't what they were either.
Well, I don't know. on my side, I'm seeing my buyers in this area. They are up against multiple offers. Actually, Southern California too. I just had another person. They were up against, I don't know, 5 different offers
Wow.
on their
That's
purchase.
because there's just nothing out there.
It's
Right.
yeah, because there's no inventory. So it's
Oh, yeah.
interesting. We had Dr. Lawrence Yun on a few weeks ago, and he was talking about how, like, oh, the Bay Area was going to get hit. Well, we're not seeing it. I mean, on the ground.
good.
I mean, it's maybe you don't have to bid $500,000 over asking anymore.
You know where we're
Thank
seeing it?
God.
Where we're seeing it is the median price, and the median price doesn't mean that home values went down. It means that there's more first-time home buyers out there than
It depends what's selling, right?
Yes,
The mix.
that's what's selling. You're seeing all these news that the mansions in LA and such are going, but that's because there's a tax coming on to LA mansions that if you sell one of these LA mansions
Next week,
like that, there's 4% tax by the city, which is
for homelessness.
outrageous. Yeah.
For homelessness.
Well, I find that outrageous. Like, wait a minute, what does a real estate agent make on that transaction? They're probably charging 4% on a $10 million deal. They're going to split it 2 ways. And here's a city coming along. So we want 4% too. It's like, but you didn't do any work for your 4%. The real estate agents, they put in a whole lot of work for that 4%. And why does the city feel that they are entitled to get the same amount of money the person that put in all the work did?
So Case-Shiller and FHFA came out with their home price appreciation.
And those
are good numbers.
Those are good numbers because those are both the same house. Now,
Yes.
the FHFA is only conforming and so on, but those are the same house. So there you don't have a mix issue.
Mm-hmm.
Well, it's interesting because FHFA excludes cash, which is a fairly significant part of the market, and also
Jumbos.
it's they're FHFA is just conventionals and excludes cash. So it skews the number a little bit. But the bottom line is FHFA was up, appreciation was up 0.2 month over month, 5.3% year over year. Case-Shiller was up 3.8% year over year and down 0.2% month over month.
And they've been down now for 7 or 8 months in a row. They're on the verge of, they're soon going to go negative. They may well go negative soon.
If you go back to the peak of, which was June of 2020,
April or June, yeah.
Down 0.6%. That is not a crash. Even if you go with
it's like nationally, it's something like 6% or something.
It's with FHFA, it's 0.6. It's 0.6. It's 0.6. If you go with Case-Shiller, it's 3%. Okay. So, and that's after 121 months of appreciation. Right. So again, people, we have got to keep this in perspective. Even if it is 3% and not 0.6%, then those are not crash numbers. That is a market leveling out. And again, they keep talking, and maybe you could speak to this a little bit, Elliot, because they're talking about the East versus the West. Well, the West had huge price appreciation over a long period of time. So yeah, we're coming down a little harder, but it's not a big deal overall.
I mean, the West has gotten much more expensive, right? You look at the coastal communities all across Oregon, Washington, California, they're crazy expensive. And Boise, they mentioned, the article in the journal today mentioned this, Phoenix, Boise, Tucson, whatever, Austin. Yeah, there's going to be some payback necessarily. And as jobs get harder and tech gets whacked a little bit, okay, this is not shocking. But there's also inflation to keep in mind here, right? Inflation is running at 6-7%. So if home prices are down by 3 and inflation's knocking off 6 or 7 more, real prices are down by 10. So this is quite a difference from what was going on in the hot market of last spring compared to now. It's much cooler, and inflation's doing a lot of the dirty work for us. Unlike in 07, 08, when you had to actually bring the price down. Now inflation is doing at 6% over 2 years. That's 12% right there. It's sort of a hidden price decline.
Well, and then let's talk about inventories. I mean, inventories are so low.
So 700,000 listings in active listings in the United States right now. 700.
It's super low. It's super low.
Crazy. Crazy.
I mean, it's up 200% from a year ago, but a year ago it was a week and a half. So, big deal. Historically, 2 months of inventory, 2.5, what it is now, is staggeringly low. And that's why things are good, even though rates are so high. Under normal conditions, these high rates would kill the housing market, but it's not happening.
Yeah, well, the other thing too about the housing market is how if the rates drop as they did back in the fall, just into the fives again, and everyone went crazy and started, okay, let's go buy. And they would gobble up that inventory in a second if that happens again. And so it's really interesting because you're hearing two people saying, well, soon inflation's going to go down. Well, you know what happens as soon as inflation goes down?
Rates go down.
Rates will go down, interest rates will go down, and things will just take off again, and then you'll have inflation again.
Or prices go up. So as a buyer,
isn't that inflation?
Well, I'm not sure there'll be inflation. We can talk about that in a second. But the key thing for buyers is take advantage of the high rates. And find your house now where there's a little bit of inventory, and then get the house, and then in a year refi, or a year and a half.
I've been preaching that for so long. This is always the best time to buy a house, is when rates are up. And because your home values are at a discount, and you can buy the house now, you get it at the discount, and then a year later, you can lower your rate by refinancing, because the market, it may not be a year, maybe 2 years, whatever it is, but eventually rates will go down, and then you can lower your payment. When people buy the mortgages or buy a house when rates are low, they can never get a lower payment than they got when they got that rate at 3%, whatever it is. The likelihood of ever going down again is slim. And so, and when rates go up, your value goes down. So it's the worst time to buy a house is when rates are low, but that's what most consumers do.
Right. And right now, if you go to a builder, I mean, they're desperate to get rid of their product. Mm-hmm. And they'll incentivize you much more than a regular homeowner will, because they want to get rid of those houses. Just they want to move them. They'll give you, a finished basement or ceiling or a roof or an extra driveway, or they won't cut the price maybe, but they'll give you all kinds of goodies.
I think it's interesting with the builders, because what we're being told is that a lot of the houses they're selling haven't even been started, let alone finished. Like, they're selling houses that haven't been built yet.
Because the shortage of houses is big. There's millions of houses we're short. This is not like 07 when we were well overbuilt.
Absolutely. I mean, a million reasons it's different than 07, right?
Yeah.
So it's okay. So I want to talk about the 2% target for a minute. So Kevin and I listened to Jerome Powell's comments after the last Fed meeting, and we're feeling pretty good about how they're deciding that, what they're doing with that. Then I read after that there is like a global consensus that 2% is the right target to have. Then I read that the 2% market target was almost arbitrarily decided upon, and Janet Yellen had something to do with it in maybe the 80s. Is that sounding? I mean, or
the first bank to utilize 2% was the mighty Bank of New Zealand. They were the one to institute it first, and a lot of it depends. I mean, look, the point is, well, we can argue whether 2 or 3 or 4 is the right number. That's a fair argument, right? 2 could be really low for a whole bunch of reasons. It's not a good idea, I don't think. But you had to pick something. You had to sort of stick to it. You had to promise that it would be what it is, because that way people could plan and base their insurance and policies and this and that accordingly. So picking some numbers is a good idea. I think 2 is too low, because we're going to hit 0 too often. When you hit 0, you get all kinds of bad problems. You have to do quantitative easing. That's a really bad idea. So you want to raise it. I would think 3 would be a better number myself, but no one calls me up. I don't know. No one.
They're not. I mean, they're so adamant about this 2%, and meanwhile,
they're not going to change it now under pressure.
No way. No way. I also found it interesting because while they're so intent on curbing inflation, their balance sheet is up to $400 billion. I mean, they've increased their balance sheet. So I explain that. Like,
all right. So the balance sheet it peaked at somewhere around 9 trillion or something. It was 4 trillion at the last.
Up 400 billion. Up to 400 billion.
It went down, and then went up to 8. Maybe it's 8 trillion, whatever. And then they've been dropping it by 100 billion a month. 30 billion on treasuries and 60 billion on 60 billion on treasuries and 30 billion MBS or something like that. And then so it came down about 700 or 800 billion bucks. And then last couple of weeks, boof, it bumped up like $400 billion.
There it is. That's the 400. Thank you.
So that's temporary, but nonetheless, it's certainly an increase, right? No question about it. The Fed hopes this goes backwards and it goes away, and then they continue their lower number. But they're never going to get back to what it was pre-COVID, when it was $3 trillion. The Fed likes having this money to spend and do. The problem the Fed faces right now is, for a long time, they were making a ton of money. they were making 50, 100, 120 billion bucks a year and giving it to Treasury. Now they're losing a boatload of money.
Right.
Because they're paying interest on the excess reserves and their portfolio's declining in value and they're losing money. So suddenly they're going to be upside down and they'll just add a line saying, you know, like, I forgot what they call it. There's some technical term like money lost, like 3 trillion bucks. And over the years, several years, they'll earn the money back and it'll be fine again. It's a central bank. It doesn't really matter. But nonetheless, Treasury isn't getting that money. Let's put it that way. So there's an atmospherics issue of central bank losing money. A number of other ones are in the same boat, mind you, but nonetheless.
Okay, let's talk about
that.
What?
You have to digest that.
The Fed's losing a ton of money, now.
Yeah, great.
And these
So
are our best bankers in the world, right? The Fed.
our best academics in the world.
They don't know no one knows the future, man. No one knows the future.
Whatever. Okay, so actually there is a question is constantly asked by one of our listeners. He will not stop until I finally, and since I love you and you love me, I'm going to pick you as the person I'm throwing this question at. Ready?
Okay.
When economists get things wrong, their predictions wrong, which as we have noticed
Is always
constantly, is there ever any sort of ramification? Do people stop listening to them? Do they get put on a naughty list? Like nothing ever seems to happen, right? So you just like, not you, but, and I don't see you making huge, predictions that are wrong. So that's why I feel good about you, but we've seen some pretty wild, stupid things.
A great example, I don't mean to pick on this guy, right? He's done a great job and he's successful, is a guy named Nouriel Roubini. He was brilliant in predicting the housing bust. He got it, he nailed it. And ever since then, he's made a number of forecasts that have all been wrong. But he lives off the one. And that's what happens. There's always, every race has a winner. The problem is the winner is different in every single race. So looking at the last winner doesn't give you any information for the next race, because no one knows. And when economists get it wrong, like me, you get from them, oops, I'm sorry, I guess I was wrong.
They don't even say they're sorry. They continue to beat on their chest and say how amazing they are and make more stupid predictions. And I'm like, stop it. You don't need to prognosticate like that. It's a total crapshoot, which is exactly what 2022 showed us over and over again, right?
The comment here from Jill
in 2022.
The comment from Jill down there that just came across the board is incorrect, actually. Jill, meteorologists have improved their forecasts, like the 3-day forecast and 7-day forecast, not beyond that, but the 3 days gotten really pretty good. Economists, unfortunately, haven't gotten any better. So we sit humbled by meteorologists, actually.
Oh my God. So first of all, you're the only humble economist I've ever met. And secondly, actually, Dr. Lawrence Union was pretty humble. But there are not a lot of humble economists. And you and I were both in Chicago recently. I was there for a week and a half. And let me tell you, I always thought it was just California weather forecasters that were terrible. Anything other than blue skies and sunshine, they're like, whoa, dude, so confused. Chicago doesn't get it right either. And I'm talking about less than 3-day forecast.
The advantage. See, in California, the radar only goes out so far into the ocean to see what's happening coming at us. But in Chicago, they have the radar that came all the way across the country to know what's
from California. Yeah, the whole West.
So they have no excuse.
Yeah. Well, so bottom line is, whether you're a meteorologist or an economist, stop making projections because they're all a bunch of crap.
But people keep asking us, hey, what do you think? What's going to happen?
Hey,
you know what? I told my daughter, just say no.
Crispin has corrected me on one of my stats. I want to just point that out. They're not 700,000 active listings. It's 578 million active listings, or 758,000 active listings in the United States right now. So I was a little dyslexic in remembering my numbers.
NAR, because NAR is putting out numbers somewhere around 900,000. It's the last day of the month. They do it every month, last day.
Well, everything's a moving target.
I think their active listings don't account already pending sales.
They don't, but they're consistent. I mean, the key thing is they're consistent. So whatever they're not including is the same. So you can compare it from month to month or year to year, and that's fair. You can argue how much there is. Different measures have different numbers. Yes, fair enough.
Yeah, but there's not a whole lot of difference between 700,000 listings and $500,000.
No, it's not that big.
Really low.
It's not that big.
200,000 people who did or didn't get a house, whether that's a big number or not. But anyway, I get your point. Okay, so basically,
No one's going to jail. No one's going to jail. Guy, no.
over that this moment. Okay, so supply chain is easing.
Yes.
Small business sentiment is low. This is all from you, Elliot. Just so you know. Manufacturing is in recession.
Yep.
Seeking confidence is near a 40-year low.
Yep.
Conference board leading economic indicators, total crap, horrible.
Yep. Atrocious.
Firms are not investing. The odds of not having it, the recession will be, it will not be hide the women and children. I thought that was hilarious. And something about a meteor and Mars, but I don't have that one straight. Bottom line is we're going to have a recession, but you're explaining it won't be bad. Right?
That's right. And that's really don't think of it. Don't go around saying, oh, we're probably going to have a recession. That's the wrong way to think, because we think of these bad recessions, these doozy recessions, however you are old, you'll remember one or two or three really bad ones. You talk to your parents, they remember the 74, 75 recession, the 80, 81. We all remember the 07, 08, 09 recession.
Yeah.
Those are the three worst recessions since the friggin' Depression. So this recession is not going to be like that. It'll just be a regular garden variety 10-month, 9-month recession. GDP falls a skosh. And if we're lucky, GDP falls even less than a skosh. And it falls, half a point this year as opposed to a full point. And if we're lucky, we get zero growth altogether. I mean, that's the range. So don't think of, recession, terrible, sackcloth, ashes, go to beg forgiveness, mea culpa, mea maxima culpa. Just a regular recession. Think 1990 and think 2000 if you can go back that far in your memory banks or something. Just a regular garden variety recession. That's it. There's nothing horrible.
But that also means, we're not going to have a dramatic change in rates due to that, though, right? Because it's not going to be a terrible recession. Is that correct? Or incorrect?
Yeah, Guy makes a good point there that the spread is big. We can get there a little bit later if you want to talk about that. But this is a regular, and by contrast, if we have a soft landing, it's not going to be spectacular and puppy dogs and kittens either. It's going to be pretty weak. We'll have 1% growth, well below trend. It'll be the worst year in several years, except for 2020, of course. We're looking at a little below zero, a little bit above zero. The recession itself isn't all that important. The point is, it'll be a pretty relatively crummy year is the point that 21 is probably going to end up being. Whether we have a recession or not, whether it's Q3 or Q4, don't stress about that.
21 or 23? You were talking about
a recession, whether it's Q3 or Q4. Whether it's Q3 or Q4.
I thought you said 21. I would just want to clarify what we're talking about. So I don't get confused. It's
the Q3 or Q4 is the issue. Don't worry about it. It'll be weak. It'll be weak. That's the point.
Everything will be fine. Just fine.
And we'll get through it.
So I thought it was interesting. We always get through it. We get through everything, right? Like we get through everything. It's a cycle.
You just don't like living through it.
Yeah, we might not like it, but if you've been in this industry more than 3 seconds, you don't buy a Ferrari in your best year. And we also know that this crap happens regularly. This is just part of what we deal with. So this one felt terrible because it was such an extreme difference from 2% to 7 and 3/8. That's why this felt so ugly. It wasn't that we aren't used to a cycle. It was just like, whoa, and again, nobody saw it coming because, the forecasters can't get it right because who knows, right?
Ouch.
I know. Well, you know what? In everyone's defense, there was that little invasion of a little country and it did throw things off after a worldwide pandemic, whatever. Anyway, it just is what it is, right? We just have to roll with it and figure out what we go and do next.
Right. And remember, 21 and 20 were terrific, were spectacularly good years. Mm-hmm. So, those aren't sustainable either. I mean, that's why tech hired all those workers because they thought 20 and 21 were going to be forever. And they go, oops.
Yeah, they're letting them go like crazy now.
You make a point, like we're watching all these tech layoffs and they're startling, right? You see the headlines, the headlines. But the tech sector is fairly small, to your words. And so all these layoffs, they overhired. And so these layoffs, even though they seem extreme and terrible, it's not so bad Is that what you were saying?
It's
Actually,
not really meaningful. It's not an indicator of much of anything.
Okay.
If companies like GM start laying off workers and food companies start laying off workers or whatever, that's where you get more concerned. These firms overhired massively, thinking that we were going to work from home forever and COVID would never go away or whatever it was. They got the future wrong too, and they hired inappropriately, so they're cutting back. But this is not a sign of a bad economy. It's a sign of an economy that's going back to more or less normal.
Mhm.
It's more when we see other sectors laying off. Okay, utilities don't lay off generally, but it's consumer durables or consumer, not staples so much, but consumer discretionary. Then you begin. That's a sign that you got a problem on your hands.
Yeah, the tech workers, it's dirty little secret with them is many of them have two jobs going.
That's also going. Yeah, that's also going. Yeah.
Okay, when you say the word mini, what does that mean? What percentage? I want facts. I want data, Kevin Cassey. Where is it? Show me the facts. Okay, so I saw an article that was talking about how there has been a huge dip in iBuying, and there's a big significant amount of the market right now in purchases is investor loans, and it's the mom and pops that are stepping in to do those loans and to buy those properties. And so again, when I'm talking to lenders who are busy, they are busy with investment properties. Busy. So get out of our comfort zone and learn something new. I'm taking a little dive on my own into construction, which I'm going to share with everyone at some point. Do you know there's construction lending going on? Imagine. So
Yeah.
we're going to definitely want to get new skills.
Yes.
Can't be Fannie, Freddie, conforming, vanilla. Like we all know how that's been going. But I also had, I heard a friend who said that 2023 is going to be the year of the Govy. So you've got VA, the year of the Govy, the government loan.
Okay.
So you've got FHA, you've got VA, and those are options that we need to make.
USDA, yeah.
Ag loans, yeah.
Yeah.
Yeah. I don't know. I don't know that I've ever closed a USDA loan. There are like 3 parcels in a 6 million mile radius of me that are USDA, possible. So yeah, that's not my thing, but it doesn't mean that it's not your thing. So make sure you're aware of what's available out there, right?
100% financing. It's a pretty sweet deal.
Yeah, learn new skills. That's always always a good solution. You have spare time, learn something new.
Speaking of that, in California, we have a new program that just came out from CalHAPA, 100% financing. They will lend 80% and then they will equity share 20%. That's the state doing it. And so you can buy something for, let's say a $500,000 place. They'll give you $100,000 towards the down payment. Now you have a $400,000 loan, no mortgage insurance. Am I correct on that?
Oh, okay. Before you keep going, just stop.
Yeah.
Because I'm working on scheduling something with them so we can do a whole thing on it and get all the facts straight. But yes, there is that option.
Pretty sweet deal. The only thing is an equity share, and I'm not 100% fan of equity shares.
Yeah, I think we have to do a dive into that. I typically haven't been either, and so maybe. But if it's the difference between you can buy a place, you can't buy a place, there's the ticket, right? But in a tight market, if you've got a lot of competition, which right now we still do, how do you get the sellers to take that deal over the person who's got 20% down, 50% down, all cash, whatever? That's tricky. It's always tricky, right?
Right.
Okay, I want to talk about Europe for a second, just because I want to really understand. Okay, what?
I said, let's go.
I know. I love Europe. I'm trying to figure out how to live there part of the time. But anyway, that's another subject entirely. Let's talk about their banks, because I'm always amazed at how connected we all are. And and then what I'd like to do eventually, just to let you know where I'm headed with this, how does it impact our mortgage industry, right? So we watched Credit Suisse get absorbed by UCB. Total disaster. I mean, in a land after we've gone through 2000, the meltdown, and we were supposed to have 2 big fails. So that is they're like 30%. They're huge.
But they were a terrible bank for a very long time.
Okay, good. Tell us about that.
Their stock price for the last 7 or 8 years, they've been steadily declining. And people say, oh, I'll double down. It's now $10 a share. It's 8, it's 7, it's 6, it's 5, it's 4. They've been slowly melting down forever. And this last thing just kicked them over the edge. A lot like the other idiosyncratic banks like SVB and First Republic or Silver Signature or whatever. First Republic may survive. But these are all idiosyncratic. They got something weird about them. But UBS has had, Credit Suisse, I'm sorry. They had all kinds of legal problems. Deutsche Bank has some of that too. They've been turning it around, but they've also had a lot of bad stuff, bad management for years. And then bad luck can catch up with you and kill you. And that's what happened to Credit Suisse.
Okay. So so Credit Suisse gets wrapped into UBS.
Yes, yeah.
Okay. Got to get the acronyms right? So now it's a huge part of Swiss economy. It's a humongous part of their financial sector, which is big. They don't have a large population to begin with. So there's lots of fear around all of that. And so as I find it interesting as I'm watching some of these banks fail and just like go away, but then some are worth saving, which Janet Yellen has said actually clearly that is a very arbitrary process here. Okay, who are you going to save? Who are you not going to save? Which deposits are you going to go over the 254? Which aren't you? Like, I mean, like those decisions seem all over the place. And then how does that trickle down to what we do, right? I mean,
well, the thing is, the government, Yellen and Marty Grunberg at FDIC and so on, these guys are concerned about a run on the banks. That's all they really care about. Okay. They don't want to run on banks. You can't have, you can close down a toy factory. It doesn't matter, a tire manufacturer, who cares?
Right.
But banks are a whole new problem. They're a truly separate breed of business. And therefore you have to treat them with kid gloves and do things that you just find really objectively abhorrent. You've got to do because the alternative can be much worse.
Yeah, it happens all the time. So if SVB had not been saved by the Fed saying we'll save everyone's deposits are guaranteed, I can literally guarantee there've been a whole bunch of other banks that would have disappeared within a week or two.
Of course, but now that it's passed, you can go say, the problem wasn't so bad. They overreacted.
Right.
So somebody asked, when will we know when real estate prices have hit bottom, when they start going back up? Like, is that like your
like 3 or 4 months after, 6 months after the bottom, we'll tell you, hey, the bottom was 6 months ago. Yeah, right.
It's sort of like, when are you in recession? We'll tell you, after we're out, right?
Well, kidding aside, I suspect somewhere this year, mid to late this year is probably the bottom. I really think that's likely. If it's worse than that, there's something seriously wrong. But let's say August or September this year is the bottom of the market. That's probably somewhere close.
All right. And what else are you seeing out there, Elliot, that we should know about that would be relevant to what we're doing every day?
Wow, I got nothing in particular right now. The banking thing doesn't look to be as bad as it was. I think interest rates are coming up. They were lower last week or 2 weeks ago because of this overwhelming fear, and now they've risen. One of the comments on the screen was an interesting one. It talked about the spread between the 10-year and the 30-year mortgage, the 10-year Treasury and the 30-year mortgage, and it's particularly large. This at some point should start to come down. The fear is that some of these banks may start selling their MBS or something. I mean, or some countries will sell their MBS, so there's going to be more supply of MBS on the market, and that's going to hurt. So, but that spread is unimaginable that it can sustain itself at this large gap right now of 300 bips or whatever it is. That's pretty unlikely. And historically, since 0809, it's been closer to 175. So we're well above its normal historical spread.
Actually, this is a question that I've had is, if you're an investor, would you rather invest in new mortgage-backed securities or older ones that are mature and have a consistent payment system, and you're buying them at a discount, and so when they come to maturity, you're going to get a bigger payout, even though the return is 2% or 2.5%, but versus the 5% on the stuff today. But I'd almost be inclined to buy the older stuff from that banks are selling off right now, because it's less likely to be paid off, and it's more likely the payment's going to be steady. Versus the ones today, 5%, in 6-9 months, they can refinance all.
They'll refi out. That's in part why the gap is so big.
So I would be inclined to buy the older stuff than be investing in new stuff. And that's what I fear with the mortgage market right now.
Yeah, buying the 3% mortgages, they're not going to refi out.
You're not going to refinance those. Exactly.
Right. And that's partly why the gap is bigger too. And the yield curve's inverted. You got some weird stuff going on, which discourages folks from getting 5-1 arms. I mean, it's all kinds of weird stuff.
I had one other big question for you, and that's just from my days at university and studying economics, one of the terms I remember was disintermediation.
Oh, yes.
And, yeah, it's a big word. And it was like my favorite big word. And for those who don't know it,
3 times in a row. Go.
Yeah.
Say it again.
Disintermediation.
Yeah.
Yeah, it's happening a lot now. It's happening a lot.
It's happening a lot. And for those who don't know what it is, because I had to like study it forever and memorize it, it's in times like this when banks start losing their depositors to competitors like U.S. Treasuries that are paying better returns than the bank's savings account, checking accounts. You can put your money in a money market account. But wait, it's fully insured. You can put $2 million at Charles Schwab and don't have to worry about the bank closing tomorrow and losing all your money. I don't know how the bank's going to handle all that going forward.
This is an issue. The total banking cash on banking is down by $500 billion or something.
Yes.
That's a lot of money. And it goes to money markets, and the money markets in turn take the money and put it in the Fed reverse repos. And that's where it goes. So this is a crazy, weird, totally weird, but yes, it's absolutely happening. And this is for people who are old enough to remember the 70s when money markets came out. Banks used to offer free toasters and microwave ovens and blenders and stuff because they couldn't offer interest on checking accounts and savings accounts. Yes. So they give you goodies because they were losing all their money to money markets. This is the same thing happening now at a smaller scale, but it's happening all right. Yes. And that makes it harder to get loans too, right? At the margin, rates are higher because there's less money and so on. So that's what the Fed wants. The Fed wants to see less lending going on, slow the economy down. Get that free toaster, exactly. My mother was all excited, get a calculator. I remember going with her to the bank to get this stuff.
Cookbooks. Used to get cookbooks.
Okay, right.
Whatever it was. Are so old. I don't remember all that.
I still have one of those cookbooks.
Oh my God. Don't even get me started. Hey, so in other news, a reminder, because we're hearing about this, to make sure your social media is compliant. Why do I bring this up? Because people are getting busted and the regulators are on social media looking to see if you have your I's dotted and your T's crossed. In other news, the DFPI, which is the California version of the CFPB, their fines are up to $25,000 per transaction for fraud. $25,000. That's assuming you're still in business after they're done with you, which is debatable. So just a reminder, as fraud has increased and is increasing, as things tighten up, people start bending the rules, they start making exceptions. Don't do that. Find a loan program that fits your borrower scenario. And if they go down the street and find someone who will take their lie and close their loan, report them. I mean, like, we really are at that point where we just need to get rid of the people who are not doing things correctly. Why are you smiling, Kevin? Am I wrong? I'm not wrong, am I? I mean, it's so counterintuitive to how we were raised. Don't tattle, don't tell on your sister. I mean, that's not, but in our industry, we've got to get rid of the bad people. And I always say guys, and I get in trouble for, singling them out. It's not just guys. So we've got to do something. So if somebody is closing a loan that shouldn't be closed in a way that it shouldn't be closed, you gotta turn them in. And the lenders, by the way, on the back end are doing so much due diligence. And they're auditing their brains out. So, and some of it's delayed. So during COVID, for instance, when we were so busy, those audits weren't happening for sometimes 9 months, a year, who knows how long. And then then there were buyback requests.
It's actually a big issue right now. All the bankers are having to buy back the dings and the dents from Fannie and Freddie. If you mention their name to Sandra Thompson to them, they don't have kind things to say about it right now, because they're having to buy back all these loans that they didn't want to be buying back a 2% loan at this current place.
Ouch. Yeah.
So our friend Harry sent us a message that said on a $2 million home in LA, the new transfer tax will be $607,000. Holy guacamole. So
a $2 million house, a $600,000? No, it can't be. It
can't be that big.
10 million. He said 600.
10 million.
Oh, 10 million.
10 million. 10 million.
Yeah.
Yes.
It's crazy.
Yeah.
That's unbelievable. 6%. That's crazy. Whoa.
I mean, what if you didn't
No,
make that much
600,000.
money on the profit? I mean,
I know.
you still have to pay the transfer tax on that.
So you can't
So-
afford to sell it? How does that work?
Yeah, so that's why they're trying to sell all their mansions right now.
Yeah, 1 week to go. They got 1 week to do it.
Well, yeah.
Hey, we have a speaker coming up that is important that we make a note, and that's someone from.
But first, in order not to confuse people, next week we will have Megan Anderson with MBS Highway. We love her. So she's always great with information on how to promote your social media, do that kind of thing, along with the usual what's going on out there. And I think it's the week after. We have Mark McCardle with CFPB joining us again. We don't think that we're going to be allowed to publish that recording. I think I don't think the CFPB is going to allow it. So you're going to need to show up live, and I will confirm the date. And I think it's the week after next.
Yeah,
You
so
will
no
need to be here
YouTube,
live. No
be there
YouTube.
live.
Yeah, you've got
Film it with your camera.
Yeah.
I didn't say that. I didn't say it. I
Elliot,
didn't say it. I
so-
didn't say it.
he comes on because I promise that I am not going to do anything that will get him fired. And so with that, we are going
Don't
to
tape it with your camera.
Yeah, don't record it with the camera.
My mistake. Bad
See,
forecast.
Here's the thing.
Ouch. Bad
Dottie, you're in
economist. Sorry.
timeout. You're in timeout, Dr. Eisenberg. Geez Louise. So yes, so get your questions ready for the CFPB though, because again, there's a lot going on. They are doing, again, it's just a look. It's just they're every 10 years, they got to look at the rules. And right now they're looking at the LO comp rule. That's what is out for comment. So again, we talked about this last week and maybe even the week before. So we'll be able to have a couple of conversations with them. But if there's something that's pressing that you think is worth talking about, let me know, let us know ahead of time so that we can make sure that we get that included in our whole conversation. Elliot, I would like people to know how they can find you. How do they find you? How do they get your 70-word economic update every single day?
Thank you, Jill. And thank you, Audrey. So the easiest way to get my daily 70 words of economics, 5 days a week, no graphs, no ads, no charts, no links, no photos, is to take your phone and text the word bow tie. That's the message, is bow tie. And the 5-digit phone number, 5 digits, is 66866. 66866. Bow tie, send, and it'll say, thank you, give me your email address. Type it in, and you're set. So it's text 66866, and the message is bow tie, and you'll hear from me. If you go to hell, I'll follow you there, and you'll hear from me for hell as well.
Not to be confused with 8675309.
There you go. Good song. Jenny. That's obviously Jenny's number, but yes, right.
That's like the only pop song I know from the 80s. But anyway, I think it was the 80s. Who knows? All right. With all that, people, Dr. Elliot Eisenberg,
Always
internationally
pleasure.
acclaimed Elliot Eisenberg. Thank you so much for being here. We love you. And
Rock
we
on.
love your information. We love your translations from, blah, 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 economics to, we can digest it.
We
And
try.
we will look forward to seeing everyone next week and Tuesday at 11 a.m. Pacific, 2 p.m. Eastern time with Megan Anderson. And then the week after that, live, because you cannot see it recorded. We cannot say this enough. We'll have Mark McCardle with the CFPB. Have a great week, everyone. Bye.